The Amish have never borrowed money from a bank. Not once. Not in 300 years. In 1923, an Ohio County court recorded an Amish community purchasing 200 acres of farmland. No mortgage lien was filed. No financing institution appeared anywhere in the paperwork. Just a transfer of land and a community that already had the capital. Every house you own, every car you drive, a bank owns a piece of it. These people figured out a way to stop that, and it wasn't luck. They call it something that doesn't translate easily into English. That's intentional. This is not a frugality story. I need you to understand that right now because that's the wrong frame entirely. This is a system story. The Amish are not debt-free because they spend less or want less. They are debt-free because they built something. A financial architecture that runs completely outside the banking system, and they have been running it quietly and effectively for 3 centuries. The average American household carries a debt-to-asset ratio somewhere between 15 and 25% when you factor in mortgages, car loans, and revolving credit. The average Amish household, effectively 0. Not because they're monks, because they built a different machine. The machine has a name. It's called GMA lending. Every Amish church district, a GMA, operates a community capital pool. And here is the number I want you to hold in your head for a few minutes, because it will not make sense yet. Some districts carry over $2 million in circulating community capital. No treasurer, no paperwork trail, no bank account. $2 million moving through a community of a few hundred families with none of the infrastructure that modern finance insists you need. Stay with me, because how that works is the whole story. In 1987, a journalist covering rural Pennsylvania attended a farm auction in Lancaster County. He was there for the color, the hats, the buggies, the spectacle. What he noticed instead was something strange. There were no financing signs, no bank representatives standing near the registration table, no mortgage lenders handing out business cards at the edge of the crowd. When bidding closed on a significant parcel of land, the buyer, a man in his 40s, suspenders, no expression, reached into his coat and produced a sealed envelope. The journalist asked around later. He was told, matter-of-factly, that this was how it worked. The money had already moved before the auction started. That journalist never published the story. But what he had seen was the surface of something that a researcher named Dr. Donald Craybill had been quietly mapping for years. And somewhere inside a church district that had been keeping records since the 1882, there existed a document, a handwritten community obligation record that some called a lobleed ledger, that tracked every contribution and every draw made by every family across decades. Not for legal purposes, not for tax purposes, because the community needed to know. In 1991, the journal Rural Sociology published a piece that described this system in detail. I want to come back to what that article confirmed, but first I need to show you the mechanism because it is almost insultingly simple. Here is how it works. Every family in a GMA district contributes a percentage of their annual harvest or income into the communal pool. The percentage varies by district, but the principle does not. You give before you need, not after. When a member needs capital to buy land, build a barn, purchase seed stock, replace equipment, the Bishop's Council reviews the request. If approved, the funds flow directly. No application, no credit score, no interest charged in either direction. Repayment happens in kind, labor, contribution, future participation. The system regulates itself with brutal elegance. If you don't contribute, you don't draw. If you drain the pool without returning to it, the community notices, because the community is the institution. It is not charity. It is not a credit union. Those are modern categories for an ancient arrangement. What this system actually creates is zero compounding debt. The money never multiplies in the wrong direction. There is no interest accruing on a mortgage at 2 in the morning while you sleep. There is no bank collecting the margin between what it pays savers and what it charges borrowers. The spread, the thing that modern banking is entirely built on, simply does not exist inside this system. Here is the part nobody tells you. You already participate in a version of this. Every paycheck that flows into a bank, every savings account that earns 2% while your mortgage charges 6%, Every insurance premium that pools with your neighbors, you are already inside a collective capital system. You just don't control it. Someone else does. Now, let's go back further, because the Amish did not invent this. They preserved it. Hutterite Bruderhof communities in German-speaking Europe were running identical pooled lending arrangements as far back as the 1530s. The Mennonite Historical Bulletin Volume 34 documented the practice in detail: neighbor-to-neighbor capital pools, communal obligation records, in-kind repayment cycles. The same machine, built 4 centuries earlier, it crossed the Atlantic. Colonial-era Pennsylvania and Virginia townships ran what were called subscription funds, informal lending circles between farming families that allowed capital to move without institutional intermediaries. The historian Winifred Rothenberg traced these networks in her 1992 work, From Marketplaces to a Market Economy, noting how deeply embedded neighbor-funded capital had become in early American agricultural practice before the 20th century rewired everything. In 1908, Congress received a report. The Rural Credit Commission had spent 2 years studying how working farming communities, including Amish and German immigrant settlements, managed capital without bank dependency. Their recommendation was explicit: the federal government should support and recognize community lending frameworks modeled on these practices. The report landed in Washington. It was shelved within 18 months. In 1913, the Federal Reserve Act passed. This is where it changes. Centralized lending authority became the architecture of American finance. Community pools were not illegal. They were something more effective than illegal. They were simply unrecognized, uninsured, legally murky, and slowly, generationally, they became unfamiliar, not because they stopped working, because the infrastructure of American commerce was rebuilt around institutions that had no interest in them surviving. Banks profit from interest. Community pools do not. One lobby showed up in Washington. The other never had to, because it never needed Washington to function. The Amish didn't fight it. They just kept doing what worked. In 1934, an FDIC internal memo specifically flagged informal community lending practices as legally unprotected, not prohibited, not shut down, simply excluded from every protection the new federal financial system offered. If your community pool was robbed, defrauded, or dissolved, you had no recourse. The message was structural: participate in the formal system, or participate in nothing that we will ever guarantee. You weren't taught this in school, not because it doesn't work, because it doesn't pay anyone to teach you. Now, back to that 1991 rural sociology article. Dr. Crabill's research confirmed something that most outside observers had assumed was rumor or exaggeration. Active GMA lending pools were operating in 12 Ohio and Pennsylvania districts. The estimated total community-controlled capital across those districts, $14 million, not in a bank, not in a hedge fund, in a system with no treasurer, no auditor, and no federal charter. And then comes the number that should stop you completely. A 2003 USDA rural development study noted, almost in passing, that Amish farm failure rates during the 1980s farm crisis had been under 1%. The 1980s farm crisis that bankrupted more than 300,000 American farming operations. While farmers across the Midwest were losing land their families had held for generations, Amish communities absorbed the shock and continued. They didn't survive that because they were lucky. They survived because no bank could call their loans. There were no loans to call. This is the part where I want you to think about your own situation. Not abstractly, concretely. Your house, your shed, your neighborhood. Because here is what most people don't realize. A version of this system is already running in communities all around you. Mexican tandas, Korean gai, Ethiopian ikub. Rotating credit associations, informal community lending circles, where a group of households each contribute a fixed amount regularly, and members take turns receiving the full pool. The FDIC published a study on these in 2014. They called them functional, effective, and broadly underutilized by the populations that could benefit most. These systems are legal. They require no financial institution. They require 6 to 12 people who trust each other enough to build something together. The principle scales to a small street, a church group, a neighborhood association, zero interest, no credit check, no compounding debt risk, full local accountability. the savings equivalent to tens of thousands of dollars over a standard mortgage term if the capital is pooled and deployed correctly. The infrastructure required: a ledger and an agreement. The people who built this country's economy quietly, generation after generation, weren't doing something mysterious. They were doing something simple. They just never stopped. And somewhere between 1913 and now, the rest of us were handed a different story. That capital requires institutions, that lending requires intermediaries, that money cannot move between neighbors without a bank standing in between to take its cut. That story made certain people very wealthy. It was not designed for you. You're the kind of person who notices when a system that works gets quietly set aside. That's not nothing. That's actually the first thing you need. If 6 families on your street agreed to do this tomorrow, what would stop them? Save this. Share it with one person who owns property or wants to. Because next, I want to show you what Amish builders discovered about insulation in the 1960s that the construction industry has never picked up, and why that gap in your heating bill is exactly as old as you'd expect.